Greetings, my name is Richard Gunderson, also known as Mr. Trader 911. This video titled How to Online Trade was produced by Trader Training Schools in October of 2011. Online trading has had a major impact on stock market investing, particularly in the last 5 years as high-speed internet service has become more widely available to the public. In this video I'll cover what is trading versus what is investing, what is online trading, the pros and cons of working with a stockbroker, and the pros and cons of online trading. The information in this video will be helpful to individuals desiring to become investors as well as current investors that do not currently trade online. We'll start with a definition of the terms trader and investor. People that are relatively new to investing often have little, if any, understanding of the difference between traders and investors. Both traders and investors buy and sell stocks. The main difference is the amount of time they hold those stocks. Investors are individuals that make an investment and hold it for a long period of time. Intermediate investors, notice the term investors, generally buy a stock with the idea of holding it for a period of several months to 1 year. Long-term investors generally buy a stock with the idea of holding it for more than 1 year. Traders are individuals that make a purchase with the idea of holding it for a short time. Day traders, notice the term traders, generally buy and sell a stock the same day. Swing traders generally buy a stock with the idea of selling it within 3 to 10 days. Position traders generally buy a stock with the idea of selling it within 3 to 12 weeks. Traders and investors go through a different decision-making process to decide what they should invest in. This process goes beyond the scope of this video and is covered in depth in my Investing for Financial Security course. Every investor can determine for themselves what style of trader or investor they want to be. This is helpful because the investing style needs to fit the personality and workload of the trader or investor. Whether a person's style is trader or investor, they have the option of investing with the assistance of a stockbroker or trading online, avoiding the need for a stockbroker. I'm going to start by looking at pros and cons of investing through a stockbroker. Some investors prefer to work with a financial professional or stockbroker to gain their help in selecting stocks to purchase. This is a good choice, especially when you're relatively new to the world of investing and have little or no training or experience. The pros of working with a stockbroker are threefold. First is their experience. Second is their conservative advice. And thirdly, the research reports available to them. Potential negatives to working with a stockbroker are, number one, brokers service many clients. Although they may be focused during a telephone conversation or face-to-face meeting and may appear to be giving you a good deal of attention during the exchange of ideas, you are not their focus. Number two, the stockbroker's firm forces them to be conservative and not to take risks. This by its very nature may not be consistent with your investment philosophy, and the results will reflect that conservative approach. Number three, brokers are often influenced by their management as to what specific investments to recommend to their clients. These investment recommendations are usually the same recommendations they're giving to all of their clients. Number four, brokers may call you with a recommendation to buy a stock. Since the broker is servicing many clients, the price of the recommended stock may already be moving up by the time you get the recommendation to buy. This limits your profit potential. Number five, brokers seldom call you with a recommendation to sell a stock. Generally, you have to watch the price of a stock and determine for yourself when to sell. Number six, when you select a broker, you'll need to sign a contract and you'll need to deposit a minimum amount of money in your account from which trading funds will be withdrawn. Number seven, when working with a broker, the broker places the buy or sell order for you. Therefore, there is a time lapse from when you decide to buy or sell until you can reach your broker, and the broker in turn places the buy or sell order. This time delay can decrease the profit or increase the loss in the buy or sell transaction. Number eight, the broker's commission fee is generally more expensive than the commission charge for online trading. Number 9, brokers work well with inexperienced investors that lack training. However, lack of training causes investors to be ill-prepared to ask the right questions and unable to discern the quality of the recommendations they're getting. Now, to be fair, some brokerage firms and some brokers are much better than others in servicing their clients. You need to be aware of the pros and cons we've just talked about. Research the brokers that are available to you before deciding to commit to working with one. Brokers may have access to equity investment vehicles that you may not be otherwise aware of. For example, they may advise you on investing in mutual funds, REITs, and DRIPs. People that would like to focus on short-term investing generally prefer to buy and sell stocks online. When we talk about online trading, we're talking about an investor or trader having the wherewithal to buy and sell stocks over the internet. The transaction electronically goes through a brokerage house, but bypasses the need to involve a stockbroker in the transaction. Let's look at the pros and cons of online trading. We'll start with the cons. Number 1, online traders need to have an online brokerage account set up with an online brokerage firm. They also require that you deposit a certain amount of cash in that online brokerage account. The amount of money required to open the account will vary dependent on the brokerage firm. Each buy order will automatically deplete cash from the cash balance in the account as orders are executed. Sell orders will automatically deposit cash into the account. Number 2, online traders are operating independently. They need to know what they're doing in terms of the investment choices they make, the timing of their investments, and the risk analysis associated with their decisions. This requires training. Without proper training, they potentially could lose a significant amount of money. Number 3, there are several choices available for all buy orders and sell orders. The online trader needs to know which type of buy order and which type of sell order to use for each buy and sell decision they make. This also requires training. Number 4, online traders need to take care when entering details of their buy and sell orders. Once they enter the order, it will be executed. Number 5, online traders need to commit to staying in touch with the market and the stocks they own. Generally, online traders need to invest more time weekly than a long-term investor. The benefits of online trading are as follows. Number 1, trades can be entered 24 hours a day, 7 days a week, but the trades will only execute during normal trading hours, which is 9:30 a.m. to 4 p.m. Eastern Standard Time, Monday through Friday, excluding holidays. Number 2, once a trade order is entered, it can be modified if the order has not been executed. Number 3, trade orders that are entered during normal exchange hours are executed within fractions of a second for highly liquid stocks, that is, stocks with high trading volume each day. Stocks with low trading activity will take longer to execute. Number 4, traders can often take advantage of short-term dips in the price of a stock in order to get a better price when buying it. For example, there are times when a stock price drops based on news not related to that particular stock. If you've been following that stock and you know that it is underpriced, a quick response with a buy order can set up a profitable trade. You're not likely to duplicate this quick response if you're buying through a broker. Number 5, traders have the same flexibility to pick the type of buy orders as they would placing orders through a broker. The same is true for sell orders. With proper training, online trading is an excellent choice with benefits such as flexibility, speed, and simplicity. Assume you have set up an online trading account. Now, how do you go about executing a trade? Most of the decisions are made by you prior to going online. The specific information you'll need when you go online is the stock symbol, the number of shares, is this a buy order or a sell order? If it's a buy order, what type of buy order? And that may require you to enter additional information. If it's a sell order, what type of sell order? That may also require additional information. Is this order a day order? In other words, good for that trading day only? Or is it good till canceled? In my Investing for Financial Security course, we cover 4 types of buy orders and 4 types of sell orders. It's important to understand each of them, when to use them and when not to use them. This subject matter goes beyond the scope of this video and requires more in-depth training. If you'd like to learn more about how to online trade, I encourage you to go to my website at www.getfinancialsecurity.com and sign up for my Investing for Financial Security course. Under the Schedule tab, you'll find the cities where this course will be taught. If your city is not in the schedule, go to Future Training, the Future Training tab, and let us know where you'd like the course to be made available. There is limited seating in each course. Each course also has a registration deadline. The registration may close early if the seating limit is reached prior to that deadline, so don't delay. If you're interested in learning how to online trade using a systematic process that can create wealth and protect your investments, sign up now. I look forward to hearing from you soon. This is your opportunity to get financial security.